G'day expats and welcome to another episode of Expat Chat, episode 84 today. And we are going to be talking another topic of property. Property has been monopolising a lot of people's conversations of late. And we're just going to go through and address some of the, I wouldn't say mistruths, but the incorrect assumptions people make when they're selling Australian property. So before we get into it, I'm going to certainly introduce my co-host and mate, James Ridley, who's the Managing Director of the Australian office and looks after clients in the Asia and Americas. G'day, James.
G'day, Brett. That was a silky smooth introduction, I should say. And as always, ladies and gentlemen, those tuning in today or viewing us, joined with Brett Evans, who is the Managing Director for the Europe, Middle East and Africa's region. Brett, how is actually the sandpit treating at the moment? Is it getting quite steamy over there? Is it quite warm yet, or what are we talking? Couple more weeks.
Topic of discussion at the moment because the mornings and the evenings are nice. They're crisp. I wouldn't say crisp.
Yeah, nice.
Cool.
Okay.
They're cool.
Yeah.
Days are hot. So days are pushing high 30s. So
Yep.
Mother Nature's going to wake up one day, whether it's tomorrow, next week, who knows, and just suddenly flip the switch and then it's afterburners on and open the oven door. But for the time being...
I was going to say, isn't there usually an exodus that happens in the next month or two?
No, that's July, mate. Everyone gets the hell out of Dodge. And, we're certainly joining them, that's for sure. So, July is that sort of exodus. And then there's the Eid break, which is the end of June. So I think there's going to be a lot of kids who are going to be leaving school early because you have the Eid break and then you go back to school for a couple of days and you have a
That's right.
break again. So it's going to be an interesting one. But, the airports are going to be rammed.
Absolutely, mate. And before we jump into today's topic, a quick little disclaimer.
At the beginning of the episode this time, but like last time when I did it, that's why you shouldn't let me do it.
I think that was my fault. I think I've taken reins over the disclaimer, but anything that you hear from today should be consumed for entertainment and information purposes only. Do not construe this as personal advice. If you do need advice, please feel free to reach out, engage a tax accountant, us, financial planners, or even a legal conveyancer of some sort, a solicitor. If you need legal advice, today should be consumed for information and entertainment purposes only. That wasn't my best, but anyway, let's jump into it today, mate.
Mate, lawyers are happy. Tick.
Yeah, that's it. That's it. Incorrect assumptions around selling property. And I think I can probably kickstart this with a client story that happened last year. And it's mainly around a client selling a property. I wasn't really notified that they were looking to sell a property. It sort of all come about very quick. And then we were told after the fact the contract had been signed. So background, bought a property a few years ago, established it as an investment property first whilst they were overseas, rented it out for about 18 months, and then moved into the property as a main residence. That worked. Did a couple of renovations to it, added a bit of value there whilst they're living in it, and then decided to sell it last year. The capital gain on the property compared to the purchase price was quite significant. It was probably over, what it ended up being, it was probably over 500,000 because they owned it for a few years now. And they had actually done some really nice renovations to it as well. Now, when they sold the property and we had that conversation, they told me the news and I was like, okay, that's great. I was like, it's going to be a taxable event. Are you aware of that? They're like, oh, hang on, back up. Why is it a taxable event? It's our main residence. I was like, yeah, it is your main residence. That is right. That's true. However, remember when you first bought the property, you actually purchased it as an investment property. You were unable to move into it and establish it as your main residence. And therefore you didn't benefit from the main residence exemption plus the temporary absence rule, that 6-year rule from the get-go. So those first 18 months that you own that property and rented it out, that still attracts capital gains tax. And because it's appreciated in value, it means the capital gain that you technically have to pay tax on is also going to be a lot more compared to probably if you didn't do the renovations. However, you do benefit from the 50% capital gains tax discount concession for the period that you lived in it, plus the period that you lived in it, that's also going to qualify for the main residence exemption. So when we sort of reverse engineered the sale, we looked at the renovations that were done whilst you're in the house, because that increases the cost base, which is good, reducing the capital gain. The holding costs while you lived in the property, things like council rates, insurance premiums, interest expense on the mortgage, those sort of things, which are holding costs, you can add as a cost-based element. I think it's cost-based element 4, the fourth one. And essentially that increases the original cost base, therefore reducing the capital gain. So once we actually went through all the calculations, we worked out the total discount that they would get from the 50% CGT discount concession plus the main residence exemption. The total capital gain ended up being about 200,000. So individually on their tax return, they had to report about 100,000 each. So that was a bit of a rude shock because it was a bit, I guess, an incorrect assumption around selling a property. And it is quite common when we are speaking to expats and a lot of the seminars and webinars that we conduct, people assume that when you buy a property and you rent it out for a couple of years, but then you move into it and establish as your main residence, that when you sell that property later on, it should be a tax-free transaction. I think in that webinar that you put on last week with Brett, with Jeremy Brett, there you go. I think I counted 4 or 5 questions which asked this exact this exact sort of thing, this topic. Is that right?
Mate, it is. And it's something that it's either people make an assumption in a too optimistic way and people make an assumption in too much of a negative way, So
Yes.
there's those who say, like your client, I lived in the property, therefore the whole thing's free. And then also too, there's people who don't realize that you can actually re-engage a partial main residence exemption on return to Australia by moving back into the property. That is, it gets lost. If you don't, haven't lived in it, then you're toast. And that's another one that catches a lot of folks out. They go, wait a minute. So if I move back into that property, then if it's within 6 years of moving out, I don't pay any capital gains tax. Like, yep. And if it's later than 6 years, you get a pro-rata approach. And they're like, oh, and something that changes everything. I think to me, the other one that I see time and time again, and this is probably driven by the property spruikers who are targeting expats to sell properties. They buy a property, investment property overseas as an expat investment. Tenant goes in, money comes through, and then when they return to Australia, they talk about selling that property. And then they assume, because they're an Australian tax resident, that they get the 50% capital gains discount for the life of the property, but they don't.
Yes.
They only get it for the period that they're a tax resident. So if you've held the property for 5 years, you're back in Australia and sell it 1 year later, then only that 1/6 of that time you've held it is discounted, and the other 5/6 you're paying full freight.
Exactly right. And it's a really common one, that one, where the assumption is made that if the sale is when I'm an Australian tax resident, I'm still entitled to the main resident exemption going way back, which technically is true to a degree, depending on individual circumstances.
It is,
temporary absence rule. The 50% CGT discount concession, though, no, only applies when you're in country, boots on the ground as an Australian tax resident. There's no retrospective treatment there for that period that you've been offshore. It's a really common one, and it's dangerous as well. And I dare say some property spruikers do say that you can benefit from. So it causes confusion for a lot of expats. But I think what causes probably the confusion there also is that if at the time of sale you're an Australian tax resident, you can still use the main residence exemption. Whereas everyone
50% is different.
That's exactly right. And that's what's, I think, translating to a bit of confusion. Hang on, I get the MRE and that's tax-free, but I'm not getting the 50% CGT discount. Why is that? And it's probably pretty typical of the way our tax system has worked and the legislation pieces that exist as they are. The other sort of, I suppose, not issue, but it has come up time and time again, is the foreign resident capital gains withholding tax. So,
especially for people who've been away for greater than 5 years since this is the introduction of this. And that's the ones I'm seeing. I had a client who sold a property in St Kilda recently and sent me all the paperwork saying where they're taking my money is. It's cool. You got to pay that money anyway. So, but you're spot on.
Yeah, that's right. So zooming out, quick background, the foreign resident capital gains withholding tax, it was introduced to essentially capture foreign residents or even non-citizen Australians that were investing in property, selling it, and then not lodging that final tax return to capture any capital gains tax, which was owed to the ATO. So they brought in this system where if at the time you were overseas, a non-resident of Australia for tax purposes, so that is most Australian expats, if not all, and the property, the sale of the property was over 750,000, then 12.5% of that sale price needs to go directly to the ATO through the PEXA system, through the conveyancing sort of process. And a lot of people panic when this happens because they're like, shit, I've just paid 12.5% on a sale worth $1 million. And when am I going to get that money back?
125,000 bickies, yeah.
Exactly. Like, am I ever going to get that money back? No. Like, so yes, you will, but you need to wait till tax time rolls around. You lodge your tax return, and if you've paid too much tax, you'll get a big juicy refund. And obviously, if you owe more tax, then you're only paying the difference there. I mean, the key concern there is probably the time value of money, where that money's gone and you can't do anything with it until you lodge your tax return. And it creates this, I suppose, a layer of concern to those clients or those expats going, when do I get that money back and what can I do with it? What's my final tax position going to be? And that's when it pays to, I suppose, engage with a professional, i.e. Ben Turner, Director of Atlas Tax. He's someone that sees this time and time again and lay out what the hypothetical CGT event is going to be, what the FR or the foreign resident capital gains holding tax is going to be, and then providing some guidance around that as well. Generally speaking, it's very hard to get out of that foreign capital gains withholding tax when you are a non-resident for tax purposes. It's just one of those sort of legislation pieces that we all cop, but often when we're selling a form of, you go.
No, I was just going to say, you can actually get around it because I helped a client just recently do it because their property they were going to sell for a loss. So there was no capital gains tax to be withheld. There's no capture there. So this is why it's important to get your ducks lined up when you are selling the property, because it does take time to apply for that exemption. It's not something that just gets rubber stamped within 24 hours of that paperwork. It does take time because at the end of the day, the conveyancer, unless they get a legal letter saying don't hold it back, they're going to hold it back.
Yep, that's right. And that certificate of clearance is invaluable, especially when you are making that kind of loss. Typically, you could get that kind of certificate before 30th of June, 2020, which was before the MRE was completely abolished, and that line was drawn in the sand. And now, obviously, many expats are impacted by that. I suppose that's sort of the key concerns that that have come about probably in the last 12 months around property. Property is very topical right now, mainly because of the interest rate environment that we're seeing. We got another point. Oh, yeah. And, geez, it caught the market off by. I mean, you look at 0.25%. It's when you look at the ASX and the cash rate tracker and what the market was expecting, it was an 83% chance of no change. So it caught the whole market off, except for that 17%.
There's actually a good lesson behind this because just direct listeners back to episode 83 last week. What did we say? Interest rate rise. Yeah. So don't look at the economists or the banks or the market. Just look at Atlas because we called it.
Well, it's an important one you make because I've talked about the concept of, well, do they pause 2 more times and then do another one? But then another one would have less of an impact in 2, 3, 4 months. And this one, whilst it wasn't baked in, it really caught the market off by surprise. Yeah. Right now in mass media back in Australia, you've got everyone talking about how they're going to afford their mortgage repayments, how the cost of living pressures. Are we going to get any bickies from the government next week from the budget? I don't think so.
No, bickies be taken away.
That's exactly right. So I think this budget will be rather sensible because what the governor talked about in their minutes was, we can see the goods inflation is coming down, which is good, but in services or the services sector, inflation's remaining quite sticky. Yeah, that's right, and it's a bit of a key concern there. So what we can probably take away from that is that each month, if that services sector is staying rather sticky, we will get more interest rates decisions. Yeah. And I think the terminal rate now is still 4.1%. in terms of where the market's still pricing it to go over the next 12 months. But we're only one rate decision away from that. So if we get that, it means probably the terminal rate will probably go up to nearly 4.5%. It seems to be central bank week this week because we know that the US FOMC, they met just yesterday, I believe. And US Federal Reserve, they went up by 0.25%. They mentioned that probably going to get a pause soon, but still driven by data, as we all are. And then the ECB, they meet, I believe, tonight, my time, Australian time. And I would say, looking at their sort of the themes there and what they've been doing, interest rate increases, I think they'll probably do 0.25, likely probably 0.5. And it just, yeah, it's remarkable that it's pretty much central bank week this week, all those decisions. I
It's
mean,
interesting. I was just going to say too, I was doing some homework, and not something, the sort of homework you normally do, but I've got a bit of a hypothesis, and I'm actually going to put my neck out. It's always sore when I do that and it gets chopped off, but I will put it out and possibly call another rate rise next month. Now, here's my theory. So Philip Lowe's contract is up for renewal, and for those who
oh
aren't
yeah,
correct,
I know where you're going with this.
they can't see me using inverted commas. Um, I think the chance of Philip getting another contract is slim to none.
Yeah,
So given his public persona, I guess is the best way to
yeah,
describe it. So he's got a tough job, and the last he's going to want to doing is doing rate rises up until the end of his contract, which is August or September. I can't remember the date. I should know because I was
yeah,
reading it yesterday. He so he's either going to get him in early and then the transition to a new governor. Now, the
yeah.
new governor, the first thing he's not going to want to do is raise rates on the first day of him joining the job. So there's going to be this gap
No.
of 3 to 4 months in that transition period,
Mm.
in which case service inflation can get worse.
Yeah.
So if I was a betting man, I'd say there's a pretty good chance of another rate rise in June, just to try and front load this. Um, you know, the when you're reading the Reserve Bank minutes, you really have to read into what they're saying, both in a literal sense, but also in the grey space behind the lines.
Yeah.
And they never, ever, ever say more rate rises unless there's a pretty good chance of more rate rises coming. I was actually quite surprised by how strong the conversation, the vernacular was in their piece, because normally they say it's on review or we are concerned. But the fact that they came out and said, with service inflation doing this, the chance of higher rate rises is there. So
Yeah.
they've actually specifically said, this is in our arsenal and we're willing to use it to get that
Yeah.
inflation down. Because when you look at Australia's inflation, people think, oh, the rest of the world is higher. No, Australia's actually one of the highest in the world right now, inflation-wise. I
At the
mean, I was
moment,
talking to
it is.
a client yesterday in Czech Republic. They're running through 15% at the moment. So I feel sorry for them. That's a tough
Yeah.
yards. But when you look at United States or UK or Europe, it's not as bad as people think. So I really believe the Reserve Bank of Australia has to start causing unemployment, because virtually what's happened is this services inflation, it's people. That's the highest cost is the people. Now we've got a very tight labour market. So that's creating this catalyst. And it's like what Jeremy and I were talking about on the webinar last week, at this tug of war between, people can't afford property, but there's no new properties being developed. So that's what's keeping the inventories low. Same thing in this inflation level. Unemployment's so low that people are getting paid more than what they normally get paid, which is causing that inflation side businesses, which is then translating into increase in expenses and costs. So virtually they're going to have to try and get unemployment to at least 4.5, maybe high 4%.
Yeah.
Before we see that start to break down. Now, obviously the construction sector, every day there's another building company going bust in Australia.
It was 2 days ago, I think, locally in Queensland.
Yeah.
I can't even remember the name now. There's been quite a few.
Yeah, and that's the thing. It's a week doesn't go by that we don't see another one pop up. And I think as rates rise, you got to start seeing more of that, not only just in the construction sector, but others as well too. Especially sectors that rely on capital, cheap capital. I mean, property is number one of that. Property thrives when interest rates are at record lows, but it dies when interest rates are at record highs. So going through looking at other sectors, that's the same. Companies with high gearing, that's going to start to bite in, because even though realistically speaking, interest rates aren't high, businesses pay more for their loans than you would pay on a mortgage, because your mortgage is backed by security, bricks and mortar. A business loan may be in the background, but they're normally paying 2% more than what everyone's paying right now. So it's a tough one. But we'll see. You're about to go on leave. So when you get back, actually, that'll be around the next rate decision.
Pretty close. Yeah,
so,
that's exactly right. Yeah.
Let's see what happens there.
Yeah, I want to take this one more step further, because I was talking to a client who's employed by one of the big four accounting firms, and they're going through a bit of a mortgage review at the moment. And because the service sector, as we say, it's been quite sticky. I'm not going to say where they are, what country they're based in, but they said, well, we need to hold off the review because they're nervous that they might be made redundant because they've just received an email saying that that big four accounting firm. Exactly right. And guys, that's the service sector. That's not the product. That's not a good side. That's the service sector. So when we start to see those kind of firms starting to make cutbacks, that's probably the beginning of, maybe this unemployment rate starting to track back up. And, the cause and effect there, unfortunately, that needs to happen. Unemployment rate needs to go up in order to fully curb down this inflation effect. So we're going to be in for an interesting trot, especially towards the end of the year as people feel the pinch on those fixed rate mortgages coming out as well. I was talking to a client just last week where they said we were doing some quick numbers, some quick math, and we're looking at their mortgage repayments. And so, it's really important that you start building into your budget right now your additional mortgage repayments, because their mortgage repayments were essentially going to double when it moves out from their fixed rate to their new variable rate. And I said, build that into your workflow right now, build that into your cash flow on your monthly repayments, what you're putting away, and the surplus that you've got right now, because that's going to change really quickly. And because it's going to kick out, it'll probably be a good time for them to actually refinance, because usually the variable rates that you get when the mortgage kicks out from fixed is pretty rubbish. They don't have to work too hard to keep you, those banks. But I guess that's a bit of an example there with that client employed by the big four. They've already announced that, there's an email went around saying there's going to be some layoffs, unfortunately, making some cutbacks, X, Y, Z. So that's sort of the beginning of what we'll probably start to see. And that's probably a really good one to keep an eye on, the unemployment rate. When we get those readouts, we don't necessarily get them on a monthly basis. We get the CPI readouts, but focusing and drilling down in the services sector, if you are a bit of a data nerd, that's probably the really important area that you really want to see starting to track downwards, because that is where a lot of the RBA's decisions will probably come from over the coming months. Personally, Brad, I think you're right. I think we'll get one more. I think I think June will be the last one, to be honest. And I'm sure. And again, what's quite interesting is usually you get a pause around the budget time. Usually you get a May pause, but he didn't. And it's funny hearing. That's it. It's funny hearing some commentary where a lot of people they thoroughly believe that Philip Lowe is going to be out of a job. So he's going out with a bang.
A bang.
Because he doesn't want to be the person that
on his watch
made some. That's it, exactly right. Made some silly remarks saying, "Hey, rates, they're not going to change till 2024, 2025, 6 months later."
Actually, let's remind the audience. That date hasn't come around yet. That's the funny thing. Like, he made that call so long ago. It's only halfway through 2023.
This is it. Mortgages started rising as of 2 days ago last year, 12 months ago. So that's when rates actually started rising. So when you think about it, that means we've only had real 2 pauses, to be honest, because of how many rate decisions there have been. But really important point you make there, Brett. Imagine where the Australian economy would be if we were still at 0.10% cash rate. Imagine where property prices would be. They would be unaffordable for most Australians in a couple of years' time if they kept going with that trend. Inflation would be double digits, probably close to 20% by 2024, 2025. So it'd be very concerning. And the Australian dollar would be worth not much at all compared to the US dollar. Probably looking at 50 cents, to be honest, because of that widening gap between the cash rate. Commodities has come off as well. I reckon he not necessarily going out with a bang, but I don't think Philip Lowe wants to be left saying, I made the silly mistake of making that decision, and then I didn't go hard with interest rates to get inflation under wrap. I think he'll want to keep doing his job naturally, not really be thinking about renewing a contract. He'll want to do another 1 or 2. That way the job gets done. There's a clear trend line there happening where inflation is coming off, and he can sort of, sit back and go, cool, I did everything in my power using the data at the time. And, we can see now that inflation is tracking back towards 4.5%, then 3%, 2 to 3% being their target by 2025.
You don't want to be the RBA governor that caused the recession.
Exactly.
At the high level, that you don't want that on your CV. So he's going to say, well, no, wasn't me. I raised rates. We slowed the economy down. But we're not going to have double-digit interest rates and all that sort of stuff as well too. So Yeah.
Yeah, that's right. And I mean, they, because of the way inflation is right now, there's not going to be much probably given next week in the for cost of living measures.
Yeah.
It's not going to be many freebies there. Maybe some small concessions, rebates, but nothing like we've had in the past. It'll be pretty sensible, I imagine. Um, I usually they give us a bit of insight into some of the releases that might impact super and tax and concessions, and maybe expats as well might get an update on the residency rules, those sort of things.
I was about to say next Tuesday. That's what I'm watching closely because
Yeah,
that sort of policy piece does have a time attached to it in terms of you just can't have the border taxation make a recommendation, all this stuff go on, then for nothing to happen, especially when Labor's on record saying it does need to be reviewed. So I give it a reasonable chance that it's going to be mentioned on Tuesday. That they need to make changes here. And if they can work out, or Treasury can work out that they can make a buck out of it and they can repair their budget from it.
I mean, it's wasted otherwise. I mean, they all the money, all the salaries that were put into the Board of Taxation under the consultation as well. I was like, if they don't address it, they've just wasted quite a lot of taxpayers' money for no reason. So they did that with the main residence exemption where, it was technically announced 2017, didn't get put through until 2020, 3 years. So, we've
got that same sort of time frame. Yeah.
It does. It's got that same kind of feeling at the moment. But I mean, outside of that, there hasn't been too many other releases leading into Tuesday's meeting. So I think it could be some things which would be a bit of a surprise. I always like to know what they're going to be talking about when it comes to super concessions, contribution caps, anything like that. Are they going to be looking to take away any franking credits? We know that with the property, they always are talking about main residence exemption. Are they going to play with that a little bit? Are they going to grandfather anything? It's always interesting, and I think we'll all be glued to the TV or just reading those notes that come out straight after it to see what little gimmies or takeaways.
Do you reckon there's going to be a policy? Do you reckon there's going to be a policy change or announcement regarding property ownership? I've heard on the traps something about if you own a second property, there's going to be a dilutionary effect on the tax breaks in terms of second investment property. I don't know. Just everyone seems to be talking about making housing more affordable. I heard it and I thought it's going to be a brave government to do it. But while Labor's numbers are on the ascendancy, they can sort of almost get away with it while they control the house.
Yeah, I mean, if you own a second investment property, so maybe a main residence, an investment property, and then a second investment property.
Exactly. Yeah.
It might be a case where they could, you could very easily build it into the tax system with a lot of the software where it dilutes the deductions that you get by, say, 20%.
Yeah, every property is 20% or something like that. Yeah, like a concertina effect. Yeah,
and exactly right. And it can reduce the negative gearing effect for a lot of Australians. And you look at how that will work through the tax system, whereby, okay, if I'm reducing 20% of the tax deductions that you get, that means that's 20% additional income that I'm going to get to tax on that additional investment property, times that by, whatever, with the Australian population. That's revenue earning through the tax system with the tax rates. How much? Well, you've got the sort of that widening tax gap that's coming through very quickly as well. But it's additional money feeding into the government's pocket and ideally, looking at a way that's going to address, I don't want to say that the deficit because they've done actually quite well, to be honest, but just the current
thanks
budget,
to commodity prices, just saying that.
Yeah. So it's a good one. A good point you make. I've said of the UK's done something similar like that at the moment. They've got a petition going around where they're looking at, I think, reducing it by 20%, or you can only claim 20%. I can't remember, to be honest. They're always looking at making tweaks, negative gearing. They changed depreciation benefits a couple of years ago where on second-hand properties, you don't get the same kind of large benefits. So, and that was grandfathering things as well. So it could be a case where they might grandfather things. So it's making it less attractive for further investment properties and portfolios and those sort of things, and building on that after you've got one or two. It's always something easy they can really implement, to be honest. The easier it is to implement something, the more likelihood it'll get put through, easier to talk about, easier to digest. When they make something super complex, it's very likely it just sits on the shelf and go, we'll come back to that. No, we won't.
And that's the issue. I think, if they can be seen to be trying to help make Australian property affordable and raise money at the same time for the budget, I reckon there's a reasonable chance they'll have a crack.
Yeah. Well, I mean, and I know we're digressing and we got to do that, but this implementation of the superannuation, the $3 million additional tax, how's this going to work when, we'll talk about self-managed super funds. I know expats can't have them, but SMSFs, if they own property, are the members of that self-managed super fund required to get a market valuation at the end of the financial year, every year going forward, to see what the unrealized growth is and if it has gone over 3 million? So they're incurring that additional 15% tax over 3 million. Probably not.
The answer will be yes. I reckon there will be, because the government, one thing they love to do, and they do very well, is add red tape and policies and procedures. So they like to make things more complicated than it has to be. It might be a good business to be in, is the valuation business, because if this gets through, I agree. It's going to be, a lot of work.
Yeah, absolutely. Industrial and commercial property. But just the mechanics of it don't make sense. It's like paying tax on unrealized gains, especially if you're in the kind of, if you're self-managed fund or your super isn't in liquid assets, you've got to come up with a very large cash amount for the tax.
Yep.
It seems too complex. And obviously Labor says, no, we're not going to have this legislator until we're out of office. It's be our next term. Yeah, exactly right. But tell you what, the way Liberals are going, Labor's going to have 2 terms here.
I think you can, it's the writings on the wall there. The Libs are ineffectual at the moment. Leadership, I was talking to someone the other day, or talking to a couple of people, and I said, can you tell me who the current leader of the Liberal Party is? No. That's how ineffectual they are. Yeah, well, we know that, but that's the thing. Like,
no one likes him.
No. So you always need that statesman type person to lead a party to victory. And we saw that with the Libs in Queensland for many, many years. They just didn't have anyone who had that gravitas with the punter, but also had the political nous to be able to navigate, the Parliament and all that sort of stuff. So, but mate, I think we'll wrap it up there. I just want to do some housekeeping as well. So next week, guys, Dubai and Abu Dhabi, we have budget seminars going on with the Australian Business Group in Abu Dhabi, as well as the Australian Business Council in Dubai. Promise you lots of value is going to come out of this one. It's going to be a cracker. Just my gut's telling me, my knees telling me, because I've got a few knee operations there. It's like aches when it rains, and I just, for some reason, I feel like this next Tuesday is going to be a lot more pivotal than last year. And the reason I say that is they're going into a large surplus, not through good stewardship, but more so good taxing on commodities, because commodity prices did very well. I do think they're going to make a lot of changes in this one, because the dust has settled since they've been re-elected. They're comfortable. Politicians get a bit arrogant. You and I have seen that with the quality advice review that Michelle Levy put through regarding improving the cost of financial services. And she's now getting quite angry about it. She's lodged petitions and all sorts of stuff, because they've had this report since December. On the election last year, they promised that changes will be made straight away.
Yeah.
Nothing's happened. So it just goes to show the temperament of a politician in Labor right now. They're willing to do some pretty crazy things because they love their own press.
Absolutely. And they don't really have to worry about other parties at the moment, because they've got the majority. It's a good point you make. May budget, it is expected this will be the budget, which obviously puts through quite a lot of things. As we know, October half-yearly fiscal update, that's nothing. It's just a nice tick and flick, whereas May is when the good stuff comes out, the big stuff, the big changes, which actually cause either a lot of concern or, plenty of freebies. We'll wait and see and how it's going to impact Australian expats, especially with the new financial year just around the quarter July. What's that mean for super? Is changing things, caps, those sort of things? Are they going to change anything around that? That's what I'll be having a close eye on as well.
And I think also, too, you think about it, say governments get a 3-year term, this is year one. So if you're going to put a few noses out of joint, you do it right at the beginning. So that when you're going for re-election in 2 years' time, all the nasty work's been done, and you can go run around in the last year kissing babies and, giving them lollipops. I don't know, just sometimes your body senses these things, and I'm sensing right now that it's going to be an interesting Tuesday. So, but guys,
Anyway, guys.
links down below.
Yep.
So if you want to join, I haven't, I've got the Dubai link, but I haven't got the Abu Dhabi link yet. So hopefully if you're listening to this a couple of days later, the Abu Dhabi link should be updated. But mate, thanks very much for jumping on this one, episode 84, incorrect assumptions about selling Australian property. I think, like a lot of folks will get a lot of value out of today's episode. And yeah, if you do, guys, love ratings, reviews. This thing's free. So all we ask from return is a bit of love on that side of it. Sharing it, we do see a lot of people sharing this, which is great. So the more people we can share this with, the more education and information we get out there in the expat community, and just help people make good decisions.
Exactly right. Thanks, guys, for tuning in today. And Brett, thanks for your time. Speak soon.
Thanks, mate. Take care.